Welcome to The Explainer. Today, we're unpacking a really fascinating and honestly often overlooked dynamic in the higher education sector. We hear a ton about the student debt crisis from the perspective of the borrower, right? But what about the institution itself? Today, we're looking at the hidden financial domino effect of student loan defaults on educational institutions. So let's dive right in and see exactly how a student's financial burden translates into a massive institutional risk.
I want to start off with this powerful hook straight from the SASB education standard. It says, entities that perform poorly on accountability metrics may jeopardize important governmental funding sources. Now, this immediately establishes the incredibly high stakes for investors, institutional executives, and policymakers. This isn't just about a student struggling to pay a bill. This is literally about an institution potentially losing its lifeline to essential government funding. It's a huge deal.
So here's our roadmap for this explainer. We'll start with the student debt ecosystem, move into institutional revenue at risk, then navigating loan regulations, measuring target indicators, and finally, policies for compliance. Let's get to it.
All right, Section 1, the student debt ecosystem, the catalyst. The SASB standards outline a pretty simple but heavily compounding three-step process here. Step 1, increasing tuition payments as education just keeps getting more and more expensive. Step 2, this forces more students to finance their education with government and private loans. And Step 3, this creates rapid growth in overall student debt. This heavy reliance on the loan ecosystem is the absolute catalyst for the domino effect we're exploring today.
Which brings us to Section 2, institutional revenue at risk, the chain reaction.
Think of this as two completely distinct sides of the same risk. For the student, loan defaults create significant economic and social externalities, high debt burdens and potentially a lack of skills actually valued by employers. But for the institution, that very same default leads to poor accountability metrics. This can mean reputational damage, a decreased ability to attract new students, and crucially, the loss of government-funded student aid. A student's failure to repay directly triggers severe regulatory consequences for the school.
So the real key here is understanding exactly why this happens. The SASB framework points out specific operational failures that lead to student defaults. We're talking about an absence of sufficient educational support and a glaring lack of career management support. When institutions fail in these areas, students graduate with high debt and acquire very few skills valued by employers. It completely undercuts their ability to get a good job and pay back their loans. It really shows us that student debt isn't just a borrower's problem, right? It is a shared risk profile between the borrower and the institution providing the education.
Moving on to Section 3, navigating loan regulations, putting it under the microscope.
If you look within the SASB industry standards, you'll see this regulation sits squarely under Quality of Education and Gainful Employment. The specific code is SVED 260A.6, and it lives right alongside core institutional health metrics like graduation and job placement rates.
Let's define this core metric clearly, because this is our focus today. SVED 260A.6 requires a description of policies relating to student indebtedness and program loan defaults. This metric is incredibly important. Why? Because it literally forces educational institutions to publicly disclose their legal and regulatory exposure to student loans. They have to open up their books and their internal playbooks to show exactly how they're managing this risk.
All right, Section 4, measuring target indicators, the scorecard.
Under this standard, an institution has a very specific set of reporting requirements. They've got to disclose if they are subject to jurisdictional, legal, or regulatory requirements regarding student loans. They have to state the potential impact on their revenue based on their students' ability to repay those loans. They must reveal any quantitative indicators they measure and report to authorities. And on top of that, they need to disclose the specific targets they're subject to regarding student loans and provide a full analysis of their performance against those targets.
This basically builds into a highly practical scorecard that helps investors and regulators assess an institution's health. It tracks jurisdictional status, revenue impact, which by the way is a stark yes or no question on whether revenue is tied to repayment, quantitative metrics like default rates, and target performance analysis. This scorecard acts like a canary in the coal mine. If an institution is missing mandated targets, well, investors know vital government funding could be cut off just like that.
Does a student's inability to repay directly affect the institution's revenue?
The SASB standard explicitly demands an answer to this question. It forces institutions to acknowledge that if their graduates fail in the real world, the institution's bottom line is going to suffer. The severity of this specific required disclosure really cannot be overstated.
And finally, Section 5, Policies for Compliance, Mitigating the Risk.
The second major half of this SV ED 268.6 metric requires institutions to provide a description of their policies and practices related to ensuring compliance. See, it's not enough to just say, yeah, we have a risk. No way, they actually have to prove they are actively managing it. They must describe the internal practices they utilize to prevent loan defaults and ensure strict adherence to jurisdictional laws. This could mean showcasing their investments in career counseling, improving educational quality, or adjusting tuition models to ensure they aren't setting students up for failure from day one.
So, I'm going to leave you with this final thought. If an institution's revenue fundamentally relies on its students' financial success, which, as we've seen through this reporting standard, it absolutely does, how resilient is its business model really? By requiring these granular disclosures, the SASB framework empowers us to see exactly which institutions are building sustainable futures and which ones are just a default rate spike away from losing their funding. Thank you so much for joining me for this explainer. I hope this helped clarify some of the hidden risks in the education sector. Keep learning, and I'll see you next time.